Welcome back. You're watching Stockwatch with me, Simon Brown, and joining me to take your stock-related questions tonight, Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole and One Ruimsig. Send your questions, email stockwatch@bdtv.co.za or via SMS to 41392 or on X using hashtag Stockwatch. Gents, appreciate the time this evening. We've got bunches of questions, but I want to kick off with Shoprite. Ricus, yesterday we had Pick and Pay, horror story. Today we had Shoprite, which is just fundamentally the other side of the coin. Stock up 5%. Question is, do we just buy it for a portfolio, or is it one of those? It's always expensive.
It is. It's a bit like clicks, but it's expensive for a reason. And you can see it from the numbers they released today. You wrote about a month ago that one shouldn't buy a second best, basically saying that Shoprite is so dominant that if you wait for a pullback, that's a great time to be in. And on a result like this, I think it's also a good time to be in it. So surprising to the upside of the price shows it.
Yeah, I mean, 280 Rand there on the chart just a few weeks ago. Jean Pierre, I mean, it is, as Rick said, it's like the clicks, right? It's never going to be cheap. It's relative, but it is quality.
Correct, and you pay up for quality until quality isn't quality anymore. So I think that's the tricky part. And when it comes to these high-quality companies like Clicks, like Shoprite, that grow their earnings at an above-average rate and grow their earnings at a higher rate than their competitors, I would say the bigger mistake you can make is not owning them. Because unless they put a foot seriously wrong, they should continue to outperform. And then, as you say, they stay expensive. And Shoprite, with selling the furniture business and withdrawing completely out of African countries that they finally decided were not there for the long term to make good returns, you still saw a little bit of African currencies in this first quarterly update devaluing quite sharply. But it shows they're doing all the right steps. And as long as they do that, it will stay expensive. It's a high-quality company. So I would rather make the mistake of keeping a high-quality company in my portfolio, even though it looks cheap, or looks expensive rather, versus the alternative of going for cheap stocks that then continue looking cheap. That's worse than expensive stocks to continue to look expensive.
So you opened two doors for me there. I'm going to go with Capy Tech first. Jean Pierre, I'm going to recuse you from it because you are a recently departed board member. Ricus, I'm going to come to you. And the question is quite simple. Is it now a good time to get into Capy Tech? It's beating the competitors. It is the best of breed. And again, it is expensive. I don't know that it's ever been cheap.
Possibly when they're listed or when they started off. But it's, since, ever since they got that business going, it's been going one way. It is expensive, no doubt about that. But they've opened up other avenues of revenue, and that's kicking in. So, yes, I think I wouldn't put all my money in it. But the real question is, why shouldn't you hold it? And I cannot really think of any good reason.
Yeah, no, I agreed on that. It is, by every metric, expensive, but why shouldn't you hold it? Jean Pierre, the other door you kicked open is the stocks are keeping getting cheaper. You know where this is leading to? Sasol, below $100. I'm not sure where it closed today. The inbox is full of people saying, is it time to buy Sasol? I don't know. I don't know. I can tell you, I'm not brave enough. Jean Pierre, Sasol.
Yeah, similar. So if the one side of the coin is that my opinion is you should buy and hold onto an expensive stock that always looks expensive, the flip side is you should not be holding a stock that looks cheap, but you expect that it will continue looking cheap. And that's what I expect from Sasol. I expect the returns to unfortunately get worse in terms of returns on assets. I expect further write-downs on assets, especially the whole Secunda complex, as that inches closer to the end of life. It's very difficult. They're between a rock and a hard place, whether they're going to spend more capital to extend the life of that plant, or to just manage it up until it closes, which is probably the right thing to do from our country's perspective, given that it's the single worst emitter of carbon in the world.
Yeah.
we just need to find an alternative for the economic implication, for all the people that are employed there and for all the petrochemical products that are that come out of that facility. So we need to solve for that. But between the rock and the hard place, there's no easy answers. And I would not want to hold Sasol, almost irrespective of how cheap it is, because I don't think there's a clear way out that's to the benefit of shareholders.
Some folks are saying a takeover, but I mean, at your point, no one wants to buy this. We can see it. Ricus, Sasol, how brave are you?
Not at all. Yeah, well, Jean Pierre has sketched the fundamental side of things very well. And yeah, and just looking at what the price action is, I mean, it's not below 100 yet, but it is below a previous sort of support level, somewhere between 110 and 115. And yeah, if you use the video of technical analysis, it's downside to about 80 Rand. Certainly not brave enough. And even if it goes further, I mean, it might become cheap on a metrics basis, but then the price goes up, you're still sitting with Sasol, which is not a good business.
Yeah. Yeah, it's the quality of the business in this regard. Ricus, we'll stay with you. We buy cars, unbundled, what, it was around 18 or 20 Rand from Transaction Capital, had a stellar run, and they're fundamentally changing. I mean, I've bought second-hand cars in the past, and it used to be going down to dark corners of Elos Street and hoping you weren't being ripped off. They really are changing the market, but they're now 30 plus. Is there still some value and opportunity in We Buy Cars?
I think so. You know, it's a great business. Obviously, the results are coming out on the 18th. I had their update a few days ago, and possibly not as good as was forecast. I would like to see what gets said in the update. But fundamentally, it is a market changer, and there's such an elephant in the business. It's going to be difficult to do it better than they. And price-wise, it's in a steady uptrend. So maybe if you're a little bit cautious, just see what the ins and outs as far as the results are concerned. But as far as price is concerned, the strategy they have, the way they are doing business and disrupting that market, yeah, again, nothing against it, and if you trust that that model is going to maintain, or that way of operating is going to maintain, then yeah, it's probably still a buy.
Jean Pierre, We Buy Cars. I mean, we've actually got a nice little sort of motor vehicle sector on the JSE now with Zeda, CMH Motors, but We Buy Cars different in that it's the second-hand space. The others are rental and new vehicles. Your take on We Buy Cars?
Yes, you mentioned CMH. That's the one of all the ones you've mentioned that reported most recently, and their new car sales division was under pressure, and it came below expectations, and the profits were sharply lower. But the fact that We Buy Cars indicated in their trading update that their normalized profits will grow quite nicely shows that there's a big difference between the type of margins you get on new car sales versus second-hand car sales. And even though new car sales are under pressure and the margins are under pressure, in a certain way that sort of feeds into a positive spin for second-hand car sales, because if people can't afford new cars, they'll migrate towards second-hand cars. We Buy Cars still has got a relatively low market share in this market. So yes, they had abnormally high margins coming out of COVID when there was a shortage of new cars, and therefore the prices of second-hand cars got bid up, and they made fat margins. So the concern was that so unsustainable that volume would not make up for the decrease in margins. But based on the trading statement, it has. So I think that really bodes well for We Buy Cars, and I think over the long term, this is one of our top companies on the JSE, high quality companies. So again, it looks expensive in the short term, but in the long term, I think it's a winner you should have in your portfolio.
Yeah, and I like that point. Question coming through, ask Jean Pierre about the best cybersecurity companies. Obviously, this is offshore. CrowdStrike had their challenge earlier in the year. Jean Pierre, I'm not sure if this is you must have had a look into it. Is there anything in sort of cybersecurity that you like?
Yes, I do like CrowdStrike, and it showed as the share price bounced back that they are so important that except for Delta, no one else could really take them on. Fortinet is another one that's quite good that I like. The others are quite expensive. There's Sentinel-1 and Cloudflare, which is part security, part hosting. They're also quite good, but Checkpoint Software is one that's okay, but I would say Fortinet is another one if you want to throw that into your name and your hat of names in the cybersecurity space.
Yeah, certainly. I mean, CrowdStrike, I got at the beginning of the year. I was looking really smart, and then it all crashed. And now I'm looking slightly smart again. It's up almost a third. Ricus, is this a space that you looked at all in the offshore market, cybersecurity?
Yeah, definitely. And similar to you, I was in CrowdStrike and I had to get out of that very quickly on a Friday afternoon. And yeah, it has rebounded, but I think there's been a disappointment in sentiment. I still think it's a very viable company. I still think they've got dominance in the market, but I don't trust this bounce back. I think the scare or the disappointment is still too fresh in people's memory, and that takes about 9 to 12 months to go away. So if there is, after this rebound, a further leg down and start stabilizing, then I'll be very interested in CrowdStrike again.
Yeah, it's a point that Wayne McCurry always makes. Markets have memories, and you need to remember that memory. Ricus, let's come to you. A couple of questions coming through around BWIN. We had results out yesterday. They were a horror. There's no surprise around that. Selling and buying properties pretty much not happening in the current environment. But is there opportunity? It's trading at a good discount to NAV. Steve Brooks, he talks a good story, but he's the CEO. He's, no disrespect to him, paid to talk a good story. BWIN, opportunity?
Look, they're in the housing market and they're in Capy Tech. All you've got to do is sort of take a drive through Johannesburg and you'll see why property or should we say residential property in Johannesburg is not exactly the flavour of the month at the moment. So if you want to be in property, then I don't think BWIN would be my first choice. It's just difficult to move units at the moment unless you're discounting or renting, and that's not really what you want as a property developer.
If you said wouldn't be your first choice, what would it be a traditional REIT or perhaps a Colgra M3?
Sorry, Simon, I think you asked what I would consider as an alternative. Our net is a little bit scratchy at the moment, but yeah, one that came out a few days ago, Spear in Cape Town, which is a far more favourable position, and certainly on the office side, even that part of the business is picking up.
Jean Pierre, certainly residential property, particularly in Gauteng, tough out there. Your take, BWIN, or would a REIT do better? It's sort of less concentrated, perhaps, in trying to sell houses to consumers.
I would say a property developer is more highly geared to the property market. So let's say when things go well, you would actually expect a home builder, a developer to do better. But when things are not going so well in the property market, a developer will do worse. And I think that's what you've seen the last, call it 5 to 7 years, where BWIN has done worse than REITs, especially on a total return basis. Because remember, the whole thing about a REIT is they distribute the vast majority of their net rental income. With BWIN, the dividend has been decreasing consistently, and it's about development profits. That's what they distribute, not rental income. So if we have seen the worst of the property market, if with now interest rates coming down, we have a recovery and you actually have a strong property market from here, then I think BWIN can do better from REITs, especially at the starting price. But it's a big if. You need to have confidence and the expectation that the residential property market will do well from current levels.
Yeah, it is that big if. Jean Pierre, let's stay with you. A question came through. Reports of the 21 billion of two-pot money paid in the first 5 or 6 weeks and the like. Which sectors would you expect to benefit the most? Is there still opportunity? Because some of them, we could argue maybe clothing, but they've already run. Are there sectors out there who still sort of can benefit from that 21 billion? And it's early days, there's more coming.
There's more coming, but 21 also, it sounds like a big number, 21 billion. But in the context of total retail sales, I think one should also be careful that you shouldn't overestimate the importance of these two-pot withdrawals. The other important point is to remember these are, by definition, people who had a salary, or earned a salary, from which the pension fund contributions were deducted. So we're not talking about low-income people who don't have jobs. We're talking about people who are, call it, lower middle or middle-income people who had decent jobs and now have decided to withdraw a part of their pension fund contributions. So given that, I do think the retailers will be most in line to benefit. Yes, the clothing retailers are the one that comes to mind. I would say the furniture retailers as well, the likes of Lewis. But to your point, it's already run. It's already up a lot. So it's difficult to see specifically from the two-pot what companies will benefit that haven't run up in price yet. And therefore, I think actually now the impact of the two-pot stimulus to the retail sector is now in most share prices.
Yeah. Ricus, I suspect this comes into your stock pick in a moment, so I'm going to ask you that. I'm going to ask you about gold. Hitting all-time highs today. The question came through to me earlier in the day. Ask Ricus, should we still be long gold or gold miners? Which is the preferred gold miner? Certainly it's been best year in my memory for the yellow metal. Is there still upside in gold?
Looks like it. I mean, there's no sign of it turning down. I mean, excuse me, trying to put a fundamental value on gold miners is very difficult because you can't really say what gold's worth. So you've got to take a look at your marginal miners, where you can get operational gearing when the price of gold goes up. And looking at gold itself, it's still going up. I don't know where it's going to stop. It will stop and it will go down, and it will go down a lot. And you lose a lot of money if you're still in gold shares and you don't sell quickly enough. But while the going is good, be in something that's reasonably marginal, not completely marginal. And for that, I'm looking at the likes of Durban Leads, maybe even something like Harmony.
Yeah, I take your point, because of course that operational leverage works nicely on the way up. It works horribly on the way down. Jean Pierre, gold? What's your take on gold?
So I think the trade is to be long the metal and short the miners over the long term. Yes, in the short term, if you have bought into a marginal miner and the gold price goes up a lot, those share prices can rocket. But they only rocket while the gold price is going up. And they can drop like a stone when the gold price stops going up and starts going down. So over the long term, what has worked is to be long the metal, short the miners, but do it in a certain size that you're comfortable that in that period in between, you will have these spikes where the miners outperform the metal. But over the long term, the metal should outperform the share prices of the miners.
Yeah, I was actually looking at, and I can't remember which chart it was, one of the local gold miners. They were basically trading at 2008 levels. Gold is up almost 13-fold since then, which perfectly plays into that. A question coming through, they got a letter from Process saying there's a dividend. Do they want the cash or the share? Jean Pierre, typically if you're going to take that cash and put it back into the share, well then take the scrip instead of the cash dividend. If you want to spend it somewhere else, then take the cash dividend. It's what you want to do with that dividend which should inform what you're going to do, what decision you make.
Correct, yes. I do think in the case of Process, it's a choice between a cash dividend or a cash capital distribution.
Good
and
point.
The difference between the two has to do with tax.
Yes.
So if it's a dividend, and if you as an individual get the dividend withholding tax will be deducted. If you have an investment company, there'll be no dividend withholding tax deducted, except for some Dutch withholding tax. So for most people, the correct thing to do is the default. So if you do nothing, you'll get the default. And the default is a capital distribution. For most people, that is better because there's no deduction from that amount. What happens is your base cost will decrease. by the amount of the dividend. So one day when you sell the shares, you'll pay a little bit more capital gains tax rather than paying dividends tax today. So for most people, go with the default, don't do anything and get a capital distribution on your process shares.
Yeah, and CGT, which is assuming what you'll pay down the line, caps out at 18%, dividend withholding is 20%. Ricus, a question coming through, a bunch of questions coming through around Boxer shares. We know a lot, but there's a lot we don't know. For example, when do they list and the like. But is Boxer an IPO that you are eagerly awaiting, or are you waiting more information first, like what price and valuation is it going to come to market?
Well, that's the one thing. But on a more fundamental basis, and I've spoken about this before, look, by the looks of it, it's a well-run business, well, specifically compared to its parent in the form of Pick and Pay. So it's got all the right noises. Now it's in the right section of the market. It's got decent margins. It's growing turnover. But we were talking about Shoprite. In the end, they still have to compete with Shoprite, and therefore that's going to be difficult. So I'd rather be in Shoprite.
Yeah, no, I take that point. Jean Pierre, there is a lot missing, such as what the valuation is going to be and the like. But I mean, is it a case of trying to go against Shoprite is just tough, even if you are Boxer?
Correct. So it will come down to the valuation. I don't think there's a question about the quality of Boxer. It is a high quality company, and their track record of growing earnings per share and maintaining high returns on capital indicate that. So it's all about the valuation. I would like to own Boxer shares at one price, but at another price, I would not want to own them. So it all depends on that. And I think they're entering a tough space if they think they're going to roll out more boxes and bump up against more U-saves and therefore compete more against Shoprite outside of their traditional strong areas in the east of the country. So it's going to be very interesting. And when it becomes a listed company, we'll have first-hand knowledge. We can see through the transparency of reporting how that fight will pan out going forward.
Yeah, and I did note from the brief Shoprite update today, they're opening more stores than Boxer, and Boxer is by Pick and Pay standards doing great guns. Let's go to stock picks. Jean Pierre, what's your pick for this evening?
My stock pick is a US-listed company that reported a couple of hours ago. PayPal, they're a payment networks provider, an alternative to other payment networks, you can say like Visa and MasterCard, but also an alternative to other payment methods. If you think about, you buy something online, how do you pay? Is it Visa? Is it MasterCard? These days, there's a long list of buttons or options, and PayPal is quite often one of them, especially in the US. They also have Venmo, which is a person-to-person payment network, very popular in the US as well. And the share price actually dropped 5% when they came out with quarterly results a few hours ago, mainly because the revenue growth was below expectations.
Yeah.
But the profit growth was strong. So single-digit revenue growth, double-digit profit growth. And people were concerned about the revenue growth being low, but PayPal have said they're focusing on profitable growth now. So in my mind, one should expect that the revenue growth will be pedestrian for a couple of quarters, while the profit growth should continue to be double digits. And because they are focusing on more profitable business, I think it's the right thing to do. And it means that the business is not too expensive at roughly a 20 times price to earnings ratio, decent double-digit profit growth per share. So I like PayPal as another network payment provider that is at least maintaining market share, in a few pockets even gaining market share against the competitors.
Yeah, and as we move away from, we'll move towards, I suppose, a more cashless society, which is definitely the trend. Ricus, your stock pick for this evening?
Talking about a cashless society, possibly wait for results due in a few days, but it's Pepco Holdings. You mentioned earlier that the market has memories, and the memory surrounding Pepco Steinhoff, obviously, that's out of the way. You might think that Pepco is a fairly boring cash business, but they are changing that, and I'm always looking for new growth vectors for a company. The first change is they move into credit retail, which they are doing very well. Last set of results, margins were up, turnover was up, always great. The movement into credit retail, that's another vector. They move into Brazil, which is doing very well as far as I can see, into that growing consumer market. And of course, their fintech business, whether it be their short-term insurance or renting out cell phones, another growth vector. So it's changed from I think, a fairly straightforward cash retail into something much more. And when compared to the likes of Mr. Price, Truers, Machinis, and even appliance, type of business like New World, I think it offers value at current prices.
Yeah, and that flash business hidden within it is an absolute gem of a business. That's all for tonight's Stock Watch. Thanks to our guests, Jean Pierre Verster from Protea Capital Management, going with PayPal, Ricus from PSG Hole and One Ruimsig. He went with Pepco. Up next, the close. Stay tuned.